Think about the last time a prospect fed you an absolute line of garbage. Maybe they promised 500 direct jobs, but when you looked at the fine print, 400 of them were temporary contractors. Maybe they promised $1 billion in investment, but the financing was tied up in a web of shell companies and crypto assets, if they would tell you at all. As economic developers, as site selectors, we are trained to smell the BS. We conduct due diligence. We check the balance sheets. But what if the entity selling the BS isn't a shady startup? What if it's the government itself? What if the entire economy is the startup and the pitch deck is built around a swamp? Today, we are going back to the early 18th century with a quick first stop in the 1630s. We're going to look at the first great financial panics. You've heard the interesting stories of public madness, right? People trading their houses for tulip bulbs, buying shares in literal empty promises. But what history books often miss is that these manias weren't just mass hysteria. They were the direct, unintended consequences of financial instruments invented to solve the most mundane problem in the world: municipal and state debt. This is the story of the genesis of the narrative economy. It's the story of how managing market psychology became a dangerous tool of national policy. And it's the story of how the world's first too big to fail bailout paved the way for the British Empire, and how the lack of one led to the French Revolution. I'm your host, Devin Hillsdon-Smith, and you're listening to Site Selectors Are People Too. This is episode 3 of our special miniseries, The Architects of Prosperity, on the price of innovation. Let's get into it. All right, welcome back, everyone. So before we dive into the swampy waters of the 18th century finance, a quick word from our sponsor. Right, did I mention that sponsor is Hyphen Strategies? Me? You know, believe it or not, it actually takes some financing of my own to keep this podcast going. Hosting fees and software subscriptions, and well, now I'm trying to throw in some AI generated sound effects that do end up costing me. So we're going to do a little bit of balance sheet magic on our end, and we are going to sponsor our own podcast. So here we go. Folks, in the economic development game, it is incredibly easy to get caught up in the hype. Every region wants to land the next mega project, and every client is promising the moon. But as we are learning today, building your economic future on empty promises or the latest industry bubble is a recipe for disaster. That's where Hyphen Strategies comes in. Hyphen Strategies is a premier advisory firm that helps communities and corporate leaders bridge that gap between bold vision and ground level reality. Whether you're navigating a complex site selection matrix, developing a resilient workforce pipeline, or trying to separate an actual viable opportunity from the latest trend, Hyphen Strategies gives you the clear-eyed, data-driven roadmap you need to close the deal. So stop chasing the hype and start building a foundation that lasts. Visit www.hyphenstrategiesllc.com to learn how we can help your team connect the dots. All right, that's done. Let's set the scene. So if you remember in episode 2, we talked about Jean-Baptiste Colbert building the ultimate command economy for King Louis XIV of France. Colbert was the ultimate site selector. But, as people do, Colbert died. And Louis XIV, well, Louis kept fighting wars. Constant, grinding, expensive wars. By the early 1700s, Europe had a massive, crippling problem. Both France and Britain were drowning in a national debt. And I want you to hold on to that word for this episode, debt. Because the great financial bubbles we are about to discuss, the ones that ruined thousands of lives, did not start because people were inherently greedy. They started because mercantilist states needed to figure out how to finance their wars without causing a peasant revolt. But before we get to the 1700s, we have to clear something up. A bit of a myth, if you will. We have to talk about a flower. Part 1, the flower that wasn't a crisis. Whenever you turn on financial news during a stock market crash or a crypto meltdown, some pundit inevitably brings up the 1630s. They bring up the Dutch Tulip Mania. So let's go back and talk about this moment in history for a moment to set this up. It is widely cited as the first recorded speculative bubble. The story we all know is that the Dutch went completely insane. Speculation supposedly drove the price of rare tulip bulbs to astronomical levels. We're talking about prices reaching like 6 times the average person's annual salary for a single tulip bulb. The story went that when the bubble burst, the Dutch economy was thrown into absolute chaos. Now, it's a great story, and it makes us feel superior to people in the 17th century, but there's just one problem. Modern economic history has largely debunked the mania part of the story. Yeah, it's mostly a myth. Or more accurately, it's a cautionary tale that got blown wildly out of proportion by moralists. Here's what's actually happened. Did prices for rare tulips spike? Yes. Did they crash? Yes. But the price collapse did not significantly damage the Dutch economy. Why? Well, it's because the so-called mania was largely confined to a very small number of wealthy traders. And more importantly, money had not actually changed hands. The general public was not, by and large, trading physical tulip bulbs. They were trading futures contracts for tulip bulbs. Some modern scholars have looked at the data and argued that it was not a bubble at all, but rather a rational economic model. Prices were responding rationally to a rise in demand. Furthermore, there were legal changes happening in the background that effectively converted these futures contracts into options contracts, which drastically changed the risk profile for the buyers. So why do we still talk about the tulip mania today? Why is it the go-to analogy? Because it endures as a moral lesson. It is a parable that greed is bad. It was written and rewritten by Calvinist preachers in the Netherlands who wanted to warn people against the sins of earthly speculation. It was a localized, brief dislocation in a niche derivatives market. It wasn't a macroeconomic catastrophe. However, if we want a real catastrophe, if we want to see the blueprint for modern financial engineering and macroeconomic collapse, we have to fast forward about 80 years. And then we have to go to Paris again. Part 2, The Murderer Who Bought a Country. It's 1715. Louis XIV, the Sun King, is dead. And he leaves behind a child heir, a regent, to run the country. And a France that is, for all intents and purposes, entirely bankrupt. This is the problem. The state is deeply in debt. And they can't raise taxes anymore because the peasants are already starving. They can't borrow more money because their credit is garbage. So, enter our interesting character. His name, a lot easier to pronounce, is John Law. John Law is obviously not French. He's a colorful character from Scotland. And when I say colorful, I mean he is a professional gambler, a financial visionary, and a convicted murderer. You see, Law killed a man in a duel in London over a woman, got sentenced to death, escaped from prison, and spent years wandering Europe, gambling and studying banking. John Law shows up in Paris, meets with the French regent and says, "I can solve your debt problem, but you have to let me try a radical experiment." This becomes known as Law's system. And the mundane solution he proposed was actually a stroke of absolute, albeit terrifying, genius. First, in 1716, Law founds the Banque Générale. This bank issues paper money, bank notes. Now, this was a totally new concept for the French public, who firmly believed that money was only physical gold and silver. Law argues that paper money, backed by land and state revenue, will stimulate trade. And he's right. It does. But you see, Law is just getting started. He doesn't just want to be a banker, he wants to be the ultimate sovereign wealth manager. He acquires a shell of a corporation called the Company of the West, popularly known as the Mississippi Company. The French crown grants this company a complete trade monopoly on the French territory of Louisiana in North America. Now, if you're an economic developer today, think about how you market an industrial park. You highlight the infrastructure, the workforce, the logistics. John Law didn't have any of that in Louisiana. It was a swamp. So, Law invented a narrative. He became a propagandist. Law fueled rumor throughout Paris that the land in Louisiana was rich in silver and gold. He printed pamphlets. He paraded indigenous people through the streets of Paris to show off the exotic wealth of the New World. He created a narrative economy out of thin air. And then he executed his genius move. Law merged his two innovations. He allowed investors to buy shares in the Mississippi Company, but they didn't have to use gold or silver. They could use government debt bills. And here's the kicker. He accepted those debt bills at their full par value, completely ignoring their deeply discounted market value. Think about that. If you held a piece of French government debt that was basically worthless on the street, John Law told you, I will treat this as if it's worth 100% of its face value as long as you use it to buy shares in my Louisiana gold mining company. People lost their minds. Law consolidated his power. He took over all of France's national debt. He took over all of its tax collection. He merged his bank and his company into a single monstrous entity that was effectively the French state treasury. Shares soared. They went from 500 livres to over 10,000. The frenzy was so intense, the wealth creation so rapid that a new word had to be invented. The French word millionaire was literally coined during this exact moment to describe the new class of investors who struck it rich overnight. But here is the immutable law of economic development. Eventually, you have to break ground. Eventually, the client actually has to see the site. The expected profits from the company's colonial ventures were slow to materialize. And by slow to materialize, I mean they didn't exist. The empty promises of Louisiana gold were exposed. There were no mines, just mud, mosquitoes, and starving colonists. Well, the narrative broke. Market psychology flipped from euphoria to sheer terror. In 1720, the bubble burst. The stock crashed to zero. John Law, who for a brief moment was arguably the most powerful man in France, was forced to flee the country in disgrace, disguised as a woman to avoid being torn apart by mobs. Now, the impact was devastating. The French government was forced to consolidate and take over the company's enormous debts. And how did the government pay for it? Well, by raising taxes in order to retire it. This financial catastrophe, this complete destruction of public trust, and the subsequent crushing tax burden laid the precise groundwork for the French Revolution that would tear the company apart later in the century. France learned that managing market psychology was an exceptionally dangerous tool of national policy. So we're going to take a quick break, and when we come back, what was happening across the English Channel while France was losing its shirt? You're not going to believe how exactly history repeats itself. Stay with us. Welcome back to the Architects of Prosperity here on Site Selectors Are People Too. So, it's 1720, and we just watched France light its economy on fire with the Mississippi Company. But simultaneously, a parallel drama was unfolding across the Channel in Britain. Britain had the same exact problem as France. They had fought the same wars. They had a massive, unconsolidated national debt of £9 million, which quickly ballooned to £50 million. And they had the exact same solution. You see, in 1711, the British created the South Sea Company. It was a public-private partnership explicitly designed to consolidate and reduce the cost of the national debt. Now, you would think the British, watching John Law's House of Cards in Paris, would say, let's be careful. Nope. In 1719, the South Sea Company looked at Paris and said, hold my ale. They proposed a scheme that was practically identical to John Law's. The South Sea Company offered to take over the entire British national debt. The mechanism was exactly the same. Holders of illiquid, low-value government bonds were convinced to swap them for safe, highly liquid shares in the South Sea Company. But there was a dark twist here. The British added a layer of fraud that would make modern Wall Street blush. To keep the stock price soaring, the company's director, a man named John Blunt, engaged in an act of massive, fraudulent leverage. He would literally lend people money to buy its shares. That's right. He was lending people money to buy shares of the South Sea Company. He was using the company's own treasury to loan cash to investors on the condition they use that cash to buy more South Sea stock, artificially inflating the price. It was a feedback loop of pure leverage. Members of Parliament were bribed with the stock. The king himself was a governor in the company. It was the ultimate insider trading ring. But remember, these markets were connected. The scheme's collapse was triggered by its twin in Paris. As the Mississippi scheme imploded in France, investors panicked. A scramble for liquidity became international. People who were leveraged in Paris tried to sell their assets in London to cover their losses, and so the contagion spread across the channel. And just like that, the South Sea bubble burst. The stock plummeted, fortunes were wiped out. Sir Isaac Newton, yes, the gravity guy, lost his life savings in the crash, famously stating, "I can calculate the movement of stars, but not the madness of men." Part 4. The Divergence and Too Big to Fail. So we have two identical schemes built on the problem of state finance, crashing at exactly the same time. Both bubbles were large-scale experiments in securitizing national debt. But here is where the story pivots. Here is the most crucial detail of all, the lesson that echoes into 2008 and into our modern economy today. The aftermath of the 1720 crash established the world's first too big to fail precedent. But the responses to that precedent created a crucial divergence between France and Britain. In France, as we saw, the system totally collapsed. The monarchy's financial credibility was delegitimized. They defaulted, they raised taxes, and decades later, the peasants brought out the guillotine. But Britain took a different path. The British system did not collapse into revolution. You see, when the South Sea bubble burst, the state intervened. Yeah, there was a massive parliamentary inquiry. Politicians were disgraced. John Blunt was stripped of his wealth. The Chancellor of the Treasury was locked in the Tower of London. But the company was saved. The state stepped in, stabilized the debt, and restructured the South Sea Company. In fact, the South Sea Company continued to operate for more than a century, effectively acting as a boring, stable, national debt management firm. More importantly, the crash of the South Sea Company eliminated the main rival to another institution, the Bank of England. The Bank of England, which was also a private entity at the time, emerged from the crisis as the undisputed stable banker to the British government. Britain's system consolidated. They created a symbiotic relationship between the Treasury and a central bank. This incredibly powerful, stable financial engine is what allowed Britain to finance the Royal Navy, launch the Industrial Revolution, and build an empire that would dominate the globe for the next 200 years. So while France burned down the casino, Britain regulated it and made the dealer the central bank. And finally, the conclusion. When we look back at the 1720s, it's easy to laugh at the people buying swampland in Louisiana or leveraging their estates for South Sea stock, right? But these bubbles were not just stories of greed. They represent the birth of financialization. John Law and John Blunt were the first to realize that national debt didn't have to be a drag on the economy. It could be securitized, packaged, and sold. They realized that you could manage market psychology. They birthed the narrative economy. If you are a site selector or an economic developer today, you deal with the descendants of these systems every day. When you negotiate a TIF district, when you look at municipal bond ratings, when you deal with state-backed incentives, you are working with the financial architecture that was built from the ashes of 1720. You are relying on the precedent that certain institutions and certain debts are too big to fail. The price of innovation is steep. In the 18th century, the price of financial innovation was the ruin of a generation. But it also built the modern economic state. I'm your host, Devin Hillsdon-Smith. Thank you for listening to the Architects of Prosperity here on Site Selectors Are People Too. Join us next time for episode 4, where we move from the stock exchanges of Europe to the ivory towers of academia. And remember, no matter how complex the financial engineering gets, site selectors are people too. If you're interested in exploring some of the theories behind today's stories, stay tuned for more after the break. If not, to all of you non-nerds out there, I appreciate you sticking with me through this one. I hope it was interesting. We now know that John is the most infamous name in the history of bubbles, and we will see you next time. All right, and we are back, nerds. We're going to get into some of the theory behind these stories, and we're just going to get right into it. Isn't too long, but hopefully this helps put some meat on the bones behind these stories and why they matter today. So, the great financial dislocations of the 18th century are frequently mischaracterized as mere episodes of irrational exuberance, right? In reality, these events represent the birthing pains of modern macroeconomics and financial engineering. They were the direct, unintended externalities of institutional attempts to solve a critical barrier to economic development: the structural fiscal deficits and sovereign debt overhangs generated by mercantilist state building and warfare. So let's look at these case by case. Case number 1. The Dutch Tulip Market of the 1630s. Market microstructure and derivative pricing. This is historically cited as the primordial speculative bubble. The Dutch Tulip Mania is often used to illustrate behavioral economics and the dangers of herd mentality, where rare bulb prices allegedly decoupled entirely from fundamental valuations. However, modern institutional and economic history has largely challenged this paradigm. Rather than a genuine macroeconomic crisis, the event is now understood as a localized dislocation within an emerging derivatives market. The lack of systemic contagion and the fact that the price collapse did not trigger a broader economic contraction was due to the market's microstructure. The trading was highly concentrated, and transactions were primarily executed via futures contracts rather than spot market cash exchanges. Furthermore, Some financial economists argue this was not a bubble at all, but rather an early example of rational asset pricing. You see, the price spikes were rational market responses to shifting demand curves and a structural legal changes that converted strict futures contracts into options contracts, thereby altering the risk-reward calculus for investors. Ultimately, the Tulip Mania endures primarily as an informal institutional guardrail, a cultural heuristic warning against speculative excess rather than a true failure of market fundamentals. Case number 2, John Law and the Mississippi Scheme, France, 1717 to 1720. Monetary expansion and fiat experimentation. The French crisis offers a much more profound case study in early macroeconomic policy, specifically regarding debt restructuring and monetary expansion. The structural deficit. Following the wars of Louis XIV, the French state faced an unsustainable sovereign debt burden, severely constraining its fiscal capacity and halting economic development. John Law, as the institutional entrepreneur, then functioned as an early architect of monetary policy, recognizing that the rigid adherence to gold and silver constrained market liquidity and stifled capital formation. And so there was a macroeconomic intervention. Law's system was a radical experiment in integrating monetary and fiscal policy. In 1716, he established the General Bank, introducing fiat currency, banknotes, to inject liquidity into the stagnant French economy. Simultaneously, he engineered a state-sponsored monopoly, the Mississippi Company, tasked with the economic development and resource extraction of French Louisiana. The securitization mechanism. So, Law pioneered a massive debt for equity swap, right? Investors were incentivized to exchange illiquid, heavily discounted government bonds for equity in the Mississippi Company at par value. By merging the central bank and the monopoly, Law effectively privatized and centralized the French treasury. And that leads to market correction and contagion. The value of the company was highly dependent on extreme information asymmetry. Law utilized state propaganda to manipulate market expectations regarding Louisiana's natural resource wealth. When the promised foreign direct investment returns failed to materialize, the fundamental value of the asset collapsed. And the resulting systematic crash destroyed public trust in fiat currency. The state was forced to absorb the company's toxic assets, leading to severe tax hikes. This destroyed the state's financial legitimacy, permanently elevating the risk premium on French debt and laying the structural economic groundwork for the French Revolution. And case number 3, the South Sea Bubble, Britain, 1720. Leverage, systemic risk, and financial contagion. Simultaneously, the British economy experienced a parallel macroeconomic shock, highlighting the dangers of early public-private partnerships and debt management. Britain faced a massive unconsolidated national debt, £50 million, that threatened to crowd out private investment and destabilize the state. And so the South Sea Company was chartered as a policy instrument in 1711 as a sovereign wealth management vehicle, designed specifically to restructure the national debt. Mirroring the French model, the arbitrage scheme of the company executed debt for equity swaps, converting high-interest, illiquid sovereign debt into highly liquid, low-yield corporate equity. And to maintain upward pressure on the stock price and ensure the success of the debt conversion, company directors engaged in fraudulent leverage, using the company's balance sheet to issue unbacked loans to retail investors, specifically for purchasing company stock. And that's what leads to cross-border contagion. The British collapse was a classic example of international financial contagion. The implosion of the Mississippi scheme in Paris triggered a cross-border liquidity crisis, popping the South Sea bubble as highly leveraged investors scrambled to cover margin calls. So, a theoretical synthesis: too big to fail, path dependence, and the narrative economy. These historical events represent the dawn of macroeconomic financialization. The Mississippi and South Sea schemes were early, high volatile attempts at the securitization of sovereign debt. Crucially, the aftermath of the 1720 crises illustrates the concept of institutional path dependence. Both crises established the world's first precedents for too-big-to-fail interventions, but the divergent state responses altered the trajectory of global economic development. France suffered institutional collapse. The failure to stabilize the system led to regressive taxation, the destruction of credit markets, and eventual violent regime change. Britain opted for institutional consolidation. The state acted as a lender of last resort, restructuring the South Sea Company and solidifying the supremacy of the Bank of England. This created a highly credible, symbiotic relationship between the Treasury and the central bank, drastically lowering Britain's cost of borrowing and providing the stable capital markets necessary to fund the Industrial Revolution. Finally, these crises mark the genesis of what modern economists call the narrative economy. John Law's reliance on manufactured hype regarding colonial wealth demonstrates that the management of market psychology, information flows, and public expectations had become a potent and highly systemic instrument of national economic policy. Sound familiar? Once again, I'm your host, Devin Hillsdon-Smith, and this is Site Selectors Are People Too. See you next time. Just a heads up, views expressed in this podcast are solely my own and are not attributable to any employers, whether past or present. Thank you.